Oh boy, here it is, the tax game. By the end of this video, you will understand the tax game better than 99.9% of people. I have spent at least 20 hours putting these slides together, trying to make them accurate to the best of my ability and simplify the tax game as much as possible. The truth about taxes is that understanding them is one of the most important skills you can develop as a wealth builder. So I'll show you how the system actually works and explain why playing the tax game is not shady. It's actually what the government wants you to do. We're going to cover three things. First, how your income is actually taxed, then the three different income buckets and how each one of them is taxed differently, and then how to think about net returns or after-tax returns, which is the number that really matters. This video is part of the Cash Flow Explorer program. We're currently in level 4, always safety first, and things are definitely getting more advanced now. Before we get into it, I need to be upfront about a couple disclaimers. I am not a CPA and I am not your CPA. What I am sharing in this video is education, not financial advice. Tax law has many nuances, and you should work with a competent, licensed professional. My goal is not to give you the tools to go out and do your taxes yourself. It's instead to give you the foundational knowledge so you can have smarter conversations with your own professionals and even be your own tax strategist in a way, and then bring those strategies to your CPA. Tom Wheelwright wrote Tax-Free Wealth, and in it he says, the tax code is not a punishment. It is a set of incentives. Every tax deduction, every tax break, every credit in the tax code exists because the government is trying to get people to do something it wants done. So this is a big change to see the tax code is not a punishment. Instead, it is the playbook for how to make and invest your money. So stick with me and reframe your thinking for a couple minutes. The average American pays roughly a quarter of their income in taxes. So in a 12-month year, you spend 3 out of those 12 months essentially working for the government. So you go to work just to pay taxes. And as a large agency, the government can struggle to spend your tax dollars effectively. At their best, tax dollars are used for infrastructure, education, energy, public health, and defense. But at their worst, tax dollars are wasted on inefficient, poorly managed programs. And I get it, it's really hard to keep track of things at that level. So the tax code gives incentives to private enterprises and individuals for what it needs help with. So examples that the government wants to encourage are things like affordable housing, energy, creating jobs, and retirement. So there are incentives for all of these things. And let me be very clear, I am happy to pay taxes when the government is a good steward of our tax dollars, but I don't want to pay them any extra. Remember, tax evasion is illegal, so that's not paying taxes that you owe. But tax avoidance is not only legal, but it's encouraged. Remember, this is the playbook for how to make and invest your money. And before you get upset that the rich pay less in taxes, just know that the tax game is available for anyone willing to learn the rules. So that's why I've made this video to try to simplify it as much as I can. Before we get into the tax game, I also want to talk about impact and what do you care about? Taxes are for the general good of the public, but you really have no control over how they're spent. You do have a say and a vote on who is in office, but as we've seen, every 4 years, somebody in office has a completely new agenda that does a 180 from whoever they replaced. I want you to think about, if you were in office, where would you put your tax dollars to make an impact? You might care about climate and conservation, faith and religious missions, veterans and military families, education and scholarships, disease research and medical care, children and youth programs, hunger and homelessness, animal welfare, first responders, arts, culture and local community, international aid, and then also your family's future. You can make such a huge impact, especially in your local community with your generosity, so I don't want to pay any extra in taxes that I don't need to. So yes, do your duty and pay your taxes, but also try to make a difference in your local backyard if you can. Now let's jump into how taxes work. These are not strict categories, but it's how I've organized it for this video. So we have income taxes, personal taxes, and investment taxes. Oh my. First, we're going to get into the income tax side of things. But in general, your gross income ends up flowing through all of these different buckets. So all of these taxes can take a bite out of your income. First, let's dive deeper into income taxes. Right off the bat, let's start with a myth that says my taxes are calculated by my annual gross income. This is how taxes don't work. Let's say you make $100,000 and you're in the 24% federal tax bracket, and then you're in the 5% state tax bracket, and then you have about 7.5% for FICA taxes. And FICA is broken up between Social Security tax and Medicare tax. In the future, I'm just going to call it FICA tax, but there's two different components there. And then some people have an extra local tax depending on the city or state that they live in. So for New York City, there's in general like a 3% local tax on top of that. In this case, you might think that you pay $40,000 in taxes and then you have $60,000 remaining, but this is not how it works. First of all, the order that you pay these taxes is out of whack, and the federal tax bracket doesn't work like that. But I'll break this all down later. Another myth that I hear is I got a raise, but it pushed me into a higher tax bracket. Now I'll actually take home less money. This is a big myth. This is not how it works. This is how the federal income taxes actually work. So you have your taxable income, and then it is taxed on a progressive or marginal tax bracket basis. So your first $12,000 of income is taxed at 10%, and then your next chunk is taxed at 12%, and then this next chunk is taxed at 22%. So this person could say that they're in the 22% tax bracket, but really they paid 10, 12, and 22% taxes. To give you a couple more numbers here, so that first $12,000 is taxed at 10%. The next $38,000 is taxed at 12%. And then the next $56,000 is taxed at 22%. This next chunk is 24, then 32, 35, and 37. So you only have a portion of your income that is taxed at those highest tax rates. Let's put some real numbers behind this. So for a 100K example for a single filer in 2026, let's make it simple and say that their taxable income is $100,000. So they are going to be paying taxes on $100,000. That first $12,000 at the 10% rate means they pay $1,200 in taxes. The next $38,000 of their taxable income is taxed at 12%. That's $4,560. And then the next 50K to round out to the end of that 100K is taxed at 22%. And that's $11,000. So once you add the chunk at 10%, the chunk at 12, and the chunk at 22, that gets you to $16,760 in federal income tax. So your effective tax rate is actually 16.8%. It's not 22%. You can say you're in the 22% tax bracket, but you're not paying that on all of your income. The next myth is saying that I pay taxes on all of my income. This is not true, and I'll tell you why. First, deductions lower how much you pay in taxes. These are the incentives that the government is giving you. So it's trying to encourage you to do certain things through tax deductions and even tax credits. So when you look through the flow of how taxes actually work, you take your gross income, and this is what you're actually paid. Let's use annual as an example. And when you do certain things, the government is going to give you a deduction. So these are all of your incentives. When you take a paycheck deduction to fund your health savings account, the government is giving you a deduction. So they're incentivizing you to do that. And then if you put money into your 401k through a paycheck deduction, that's another thing that's going to help you. What these two items actually do is they lower your gross income to get you to your AGI, adjusted gross income. Then on top of that, you then take the standard deduction, and then the remaining amount is your taxable income. So this is what you are actually going to be paying taxes on. If you make 100K gross, you're not going to be paying taxes on 100K. It might be closer to, 80 to 70K, who knows? And a special call out for the FICA taxes. So the HSA deduction is so awesome that it lowers your gross income, and then your FICA tax is assessed on that amount after your HSA paycheck deduction. So typically your FICA tax comes out of your gross income, even before your 401k. So the FICA is taxed on the highest amount of your income possible, but the HSA lowers that. I might be speaking mumbo jumbo to you. This is just a little detail. It's not that important to know when FICA is taxed, but the takeaway here is that things like your HSA deduction and your 401k deduction actually help you pay less in taxes. I think it's helpful to bring in these examples. So let's look at this single doctor who's earning 100K gross in 2026. So they have 100K gross income and they put $4,000 into their health savings account. So the remaining gross income that they have is $96,000. Then your FICA taxes are assessed on that $96,000 and they're 7.65%. So you're going to pay $7,344 in FICA tax. Then your 401k paycheck deduction comes after your HSA deduction. So let's say she puts $10,000 into her pre-tax or traditional 401k. That means she has a remaining of $86,000. Now her AGI, adjusted gross income, also called your above the line income, is at $86,000. Then she takes the standard deduction, which is 16.1K. And that gets her remaining taxable income down to 69.9K. So above and below the line is before you're taking your standard deduction or itemizing. As you can see, this gets complex pretty quickly, but I've tried to break it down in a really streamlined kind of staircase method. You're probably gonna have to watch this video 3 times, but it is so worth understanding. So to build off of this, deductions lower how much you pay in taxes. These are the incentives, and you can choose to take a standard deduction or itemize your deduction. And here's the differences between these two. So the standard deduction gives you a flat amount every year. It's essentially like a discount on your taxes. So for 2026, the single deduction is 16.1K and the married deduction is 32.2K. But definitely look up the current year amount so you understand what it is. The great thing about the standard deduction is that it's simple and easy. If you're filing your taxes, you're probably choosing the standard deduction and it makes it super easy. Some of the cons is if you have a more advanced tax setup, you could be leaving money on the table. For the itemized deductions on the side, this is where you're actually itemizing like a receipt. So you're adding up all of your qualifying expenses that can lower your tax bill. So common expenses that can lower your tax bill include mortgage interest, state and local taxes. These are also called SALT. You also have charitable donations. And then if you have medical expenses that are more than 7.5% of your adjusted gross income. Within the itemized deductions is also where you have these tax strategies. So you have investment paper losses, and there's also business paper losses and write-offs, as you've heard. So the benefit of itemized deductions is you can get all of the tax deductions that you deserve, but the cons is that it's more advanced and you'll probably need a CPA. At the end of the day, you want to choose whichever deduction strategy is larger in order to offset your taxable income. Remember that both of these are a discount off of your adjusted gross income to then get you to your taxable income. So when we go back to the staircase, you still have all the same things, but you see below the line, you can choose to take the standard deduction or itemized deduction. So you take whichever one is bigger. Let's continue going with the single doctor who's earning 100K gross in 2026, so you can see what she is actually going to pay in taxes. So she has that taxable income of 69.9K. So of that 69.9K, the first 12K is taxed at 10%, the next 38,000 is taxed at 12%, and then the next 19.9K is taxed at 22%. So she pays 1,200 in taxes plus 4,560 plus 4,378 to get to $10,138 in federal income tax. So even though she is in that 22% tax bracket, she has an effective federal tax rate of 10.1% on her 100K gross income. It's not 22%. So typically you think about how much taxes you pay on your gross income, but the actual amount that you're taxed against is your taxable income. But the federal tax is just one piece of this. Let's move into the other taxes that she needs to pay. So remember, for her gross income, she has 100K and she put $14,000 into her HSA and 401k. So she has a remaining adjusted gross income of $86,000. She also has that FICA tax she paid up front, and that's going to drop down to the bottom here. She then chooses to take the standard deduction. So you have $86,000 of your adjusted gross income minus the standard deduction gets us to that taxable income of 69.9K. And then we worked through this process. So she paid $10,138 in federal income tax. That's what this number is. And then the state income tax, every state's a little bit different, so you're gonna have to work with your CPA on that one. But let's say in this case, the state charges a flat 5% income tax. So 69.9K times 5% is another tax of $34.95. And then if she lives in New York City, she has an additional local income tax at 3%, which is $2,097 in taxes. So when you add up all of these things, you got the federal income tax, state income tax, local income tax, and FICA taxes. You add it all up, and it's $23,000 in taxes off of her adjusted gross income of $86,000. So her net income of what actually goes into her bank account, what goes into her pocket, is about $63,000. And I'd also just like to add that not everybody pays state income tax or local income tax. It's generally pretty rare to have a local income tax. And then for state income tax, I think there's about 9 states that don't charge an income tax right now. A lot of people know that Florida doesn't have one. So sometimes people can even move to Florida and erase their state income taxes. However, I'm sure you also pay for it in the rising cost of insurance or property taxes. But that's beside the point. The takeaway for this slide is that she brings in $100K in gross income. She puts $14,000 into her deductions for her retirement investing through her HSA and 401K. 23K goes to taxes, and she gets $63,000 into her bank account. So of 100K, you have 63 that actually hits your bank. That is why tax strategy is important. If you can make a couple legal moves to save $5,000 on your taxes, that is guaranteed money back in your pocket. So tax strategy is actually the highest ROI investment. And then you could use that money to fund your Roth IRA or something. As you can tell, there's a lot of moving pieces to income taxes. So if you have to rewatch this section a couple times, that's totally okay, but you can visualize it as a staircase that gets you down to your taxable income. All right, so to go over some details and review income taxes, your tax bracket is the highest tax bracket that your taxable income hits, but your effective tax rate is essentially what you actually end up paying. FICA is Federal Insurance Contributions Act, and it's a combined extra tax made up of Social Security of 6.2% and then Medicare at 1.45%. You can max out your Social Security payment in a year, but you can't max out your Medicare tax. You also have an additional 0.9% Medicare tax for high earners. Also note that different states have different calculations for their state income tax. Some states have no state income tax, some states it's a flat tax, and others it's another progressive marginal tax bracket like the federal income tax. And then lastly, some cities and states have an additional local tax. To round us out here, deductions are the incentives that lower your taxable income, and the tax code is that playbook for how to make and invest your money. So the government is telling you what to do. Let's get into a couple more examples. So this is a single filer in Florida. His gross income is 150K, so he's crushing it. He puts in $4,000 into his HSA, and then he pays $11,000 in FICA taxes. And then he also moves $15,000 into his pre-tax or traditional 401k. So the HSA and 401k deduction lower his AGI to 131k. Then he takes the standard deduction, and now his taxable income is 114.9k, which he then pays US federal income taxes on with his progressive marginal tax rate. And then there is no state income tax in Florida, so he has no taxes there, and there's no local income tax. So his total taxes that he pays is $31,000 with an effective tax rate of 21%. And the net income of what actually hits his bank account is 99.6K. Now let's look at a married couple that lives in New York City. So they have a gross income of $350,000. They put in 8K into their HSA. They pay 27K in FICA taxes. Then they put 20K into their traditional 401k. So the HSA plus the 401k gets their AGI down to 322K. Then they take the standard deduction, which is doubled for a married filing jointly, to get them to their taxable income of 289.8K, which then they pay US federal income taxes of 55K, New York state income taxes of 17K, and then New York City local income taxes at 11K. So their total taxes is 110K with an effective tax rate of 31%. So their net income off of 350 is $212,000. So in one scenario, you pay $31,000, the other one is $110,000. And it is no small stretch to say that taxes are the single largest expense you'll pay in your entire lifetime. You're thinking about how can I generate passive income and cash flow, but really, we're the ones generating passive income for the government this entire time. So there you go. All right, moving on. Let's go into personal taxes. So things like property, sales, excise, and estate taxes. So these are the common taxes in this kind of personal bucket. So property taxes are paid based on the assessed value of real estate that you own. It is set by the local government. So it's your city or your county, and it pays for local things like schools, utilities, hospitals, and the library. And then sales tax, which you've seen before, is added to the bottom of a receipt anytime that you buy something. The national average sales tax is 7.5%, and this is set by your state. Then there is also an excise tax, and that is kind of a hidden tax based into the cost of goods and the price of gasoline, tobacco, and alcohol. So you don't see that tax, but companies pay it and kind of pass it on to you. And then lastly, the estate tax is an extra tax on the total value of your estates or assets when you die. So currently, if your estate is under $15 million, so the value of all of your assets when you die is under $15 million, you don't pay an estate tax. But if you die anywhere over 15 million in your estate value, you get hit with that 40% tax. That's really all we need to cover in personal taxes. There's not much you can do here. You can kind of fight the assessed value of your property, but everything else you're just going to pay. Estate tax, you can also get around that through some trust structuring stuff that we can talk about later in level 7. All right, cruising right on ahead to now investment taxes. So let's break these down. The common investment taxes that you'll see are definitely capital gains as number one. And this is the tax on the profits when you sell an investment. So short-term capital gains applies when you hold an investment less than a year, and it's taxed at ordinary income rates. So those are all the tax rates that we just went through. They're higher. But long-term capital gains held longer than a year are taxed at 0%, 15%, or 20%. Depends on your taxable income, and I'll break all of that down. But as you can immediately see, short-term capital gains, it's ordinary income tax. Long-term capital gains are much lower tax rates. And just to be very clear, short-term capital gains applies when you've held anything 1 year or less. So long-term capital gains is 1 year in a day, and then you can sell it, and now you have the better tax rates. Next, you also pay taxes on dividends. So this is the tax on the cash payouts or dividends from your investments. And there's two different types. The first are non-qualified dividends like REITs, foreign stocks, or short holding periods. Those are taxed at ordinary income rates. And then there are qualified dividends, which are most US stocks held longer than 60 days. Those are taxed at long-term capital gains. We also have interest, so you pay tax on the interest that you earn. So when you move your emergency fund into a high yield savings account, you will be paying taxes on that interest that you receive. Same thing if you're doing private or hard money lending, that is all taxed at ordinary income rates. Something pretty cool though is that municipal bonds, also called muni bonds, their interest is generally federally tax-free and sometimes state tax-free. You can also sometimes invest in local bonds with your city, and they have a really good tax treatment. And lastly, for those with a higher income, there is a NIT tax, and that's an additional 3.8% investment tax on top of it. And that stands for the net investment income tax. So if your modified AGI is above a certain level, it applies to all investment or passive income, such as interest, dividends, capital gains, rentals, royalties, and any passive business income. So you get taxed at your different tax rates, and then you have the 3.8% net tax on top of that. All right, that's enough of me talking, so let me show you how this actually works. So this is with a single filer, and these are the tax brackets that we're really used to. So you have your ordinary taxable income brackets at those numbers 10, 12, 22, 24, 32, 35, 37. So this is what we've already seen before, just as a refresher. However, when we're looking at your investment taxes, it's a bit of a different bracket setup. So your long-term capital gains tax brackets in 2026 at least, up from 0 to $49,000, you actually pay 0% tax if you have a long-term capital gains. So if you were holding stocks longer than a year and you sold them this year, then you would actually pay 0%. So the first $49,000 of capital gains is actually taxed at 0%. And then the next huge chunk is at 15%. And then if you're above $545,000, the next chunk of long-term capital gains is taxed at a 20% tax rate. And just like income taxes, these are examples of tax brackets for single filers. But if you're married filing jointly, the brackets are roughly doubled. So you can see a single filer, it's 12, 50, 106, 202, 256, and 640. For married filed jointly, it's about double. It's not perfect, and these numbers are rounded just for simplicity. So if you're married filing jointly, you essentially get double the limits of the brackets, but all the tax rates are still the exact same. Let's break down a couple examples. So first, with a single high earner, she is in her peak earning years. So she has her ordinary income, she's paying 10%, 12%, and then up into that 22% tax bracket. But she also had an investment sale. So her long-term capital gains actually stack on top of ordinary income. So you pay all of your ordinary income tax first, and then your long-term capital gains, all of your investment profits that you've held longer than a year, then start where your ordinary income ended, and then it fills up this bracket moving forward. So she's going to pay up to 20% taxes on her ordinary taxable income, but for all of her long-term capital gains, she'll only pay 15%. The takeaway here is that you can see that 15% on capital gains is better than 22% on ordinary taxable income. Let's move on to another. So this is a married retired couple who's just out there golfing all the time. Now at this point, they are living off of their investment portfolio. They actually have $0 in ordinary taxable income. So you can see there is no ordinary taxable income. Previously with our doctor, they had a big ordinary income that then pushes their long-term capital gains into the next bracket. However, since there is no ordinary taxable income and they're just living off of their portfolio gains, they're going to pay 0% taxes on all of these long-term capital gains up to $99,000. So the takeaway here is that you can actually pay $0 in taxes living off of your capital gains. That's at least how the current tax rules are written. Let's go to our next example where we have a single business owner. He has a very successful business and he is investing for his future. So you can see he actually has a massive amount of ordinary income and he's paying up to 37% on his ordinary taxable income. So he's making this big chunk of income and then he is choosing not to sell any of his investments. So the takeaway here is that he is in this highest tax bracket, but he's choosing to not sell his investments because he doesn't want to pay 20% capital gains tax. It's just like this retired couple. In this case, they had no income, so then they were then selling their investments at a really low capital gains tax rate. In this case, he's taking all the hit on his ordinary income and he's choosing to let his investments just grow without selling them at a 20% tax rate. Let's do one final example with a married couple with one that is staying at home. So there's one W-2 income coming in and there's also a large investment portfolio. So with this ordinary income, they're paying up to 22% on their taxable income. And then with the big chunk of long-term capital gains, this whole amount is in the 15% bracket. So the takeaway is that living off of long-term capital gains is more efficient than earned taxable income. To review how taxes work, there are income taxes, personal taxes, and investment taxes. And your gross income is all of your income from the calendar year. You're going to add up everything, your wages, interest you earned, short-term gains, long-term gains, qualified dividends, anything that you received. And then your taxable income is all of the income that you actually owe taxes on. You can use deductions to lower your gross income to get you to your taxable income. And then within your taxable income, there's two buckets: ordinary income and capital gains. Ordinary income is taxed at that 10 to 37% bracket, and then you pay state taxes after that. And then long-term capital gains is taxed at the 0, 15, 20% brackets, and then you pay your state taxes after that one. And you always pay taxes on your ordinary income first, and then long-term capital gains tax on top of that amount. It's hard to keep track of all this stuff, so I highly recommend working with a CPA who can do this for you, but you need to be educated, ask the right questions, and know what you can do about it. Speaking of what you can do about it, let's move into the income buckets section. Let's start with the true or false question. There are two types of income, active or passive. Is this true or false? So we do have active and passive income. Active income includes wages in businesses with material participation. So this means you are involved. You are actively growing this business or a part of it. And then passive income is from rental real estate, and then businesses that you are not materially involved in. So this is a passive business. However, there is more to this story. The answer is actually false. There are not just two types of income, active and passive. There is a third bucket, and this is portfolio income. And this includes your stock and crypto gains, as well as dividends and things like private credit, lending, and your high yield savings account interest. So, what is so important about these three different income buckets? Well, to play the tax game and to lower your taxable income, your income buckets need to align to the corresponding loss buckets. Let me break this down. So, when we talk about active income, the only thing that can offset active income and lower your active income is by pairing it with active losses. And active losses isn't the perfect term for this because things like your HSA and pre tax 401k contributions actually offset your active income and it lowers it. But in general, these are all the things that can offset active. So if you're running a business on the side and it's not profitable, but you have plans to make it profitable in the future, those losses, as long as it's an active business, can offset your active income. And then you also have things like the short term rental loophole. This is where people buy Airbnb properties and then they manage them themselves. At that point, it's not a real estate business, it's more of an active business. So the money that you put into that Airbnb to furnish it, and you get all the depreciation for the property, that stuff offsets your active income. And you also have oil and gas investments as long as you get intangible drilling costs. But that's a thing for level 6, I think. But overall, you take your active income and your active losses or anything that offsets that active, and then it gets you down to your net active income. So that is what you'll actually pay taxes on. And the same thing works in this passive bucket. So anything that offsets your passive income needs to be a passive loss. This includes depreciation and then passive investment expenses and losses. So we'll dive into this a bit more, but when you're buying a commercial real estate property, or any real estate for that fact, or even businesses with big, heavy machinery, all of those assets get depreciated. And sometimes you can accelerate that depreciation and take more of a tax bonus in the first year. And so this is a big way to offset your passive income. And if you invest in a passive business or any other passive real estate property that is not profitable, those types of things will also offset your passive income. Lastly, let's talk about portfolio income. So to offset your gains, you also have to have portfolio losses. This is where people get into things like tax loss harvesting. And then also, if you take a margin loan from your portfolio to do more investing, that interest is also deductible against your portfolio income. So overall, the takeaway, you have all of your income, you subtract by the losses, and that offsets it to get down to your net income for each one of these buckets. And to show you how this works in reality, typically you have a big bucket of active income, but then it's difficult to have active losses. So it can be harder to offset your active income. In the middle category, typically you have too many losses because you have huge chunks of depreciation from real estate investments, and then you don't have enough passive income to actually offset it. And then for your portfolio income, this one is generally easier to balance within the bucket. It's made pretty easy through tax loss harvesting. So the ranger tip here is that balancing your income buckets creates more tax efficiency. This is the basis of tax strategy. When your buckets are all out of whack and really overweighted in one way, that leads to tax inefficiency. So we want to align our income buckets to lower our taxable income. The taxes for each of these buckets are different. I wish this was simpler. I really did, but I'm showing you guys how it works. So the income buckets have different tax situations. In the active side, generally it has the worst tax rates. So you're paying ordinary income tax and you're also paying that 7.65% FICA tax on top. So anytime you have that active income, you're getting hit with the FICA tax, and that's not great. In the middle, with passive, you have better tax rates. You're still paying ordinary tax rates, but you don't have that FICA tax anymore. So any of that passive income, you have no FICA. And then portfolio has the best tax rates. It's a mix between ordinary and long-term capital gains taxes, but there's no FICA. To visualize this in some other buckets, you can see that most of the things you're going to pay ordinary income tax on, and then a sliver of your portfolio income you'll pay capital gains tax on. To split this out in detail so you know exactly what type of income goes where, I'm going to break this down. So all of the things in this ordinary income bucket, first of all, active income. that ordinary tax plus FICA. It's your wages, self-employment, businesses with material participation. So any active business is also active income. And then passive income, still ordinary with no FICA. This includes your rental real estate, limited partner distributions, like if you're an investor, and then a business without material participation. So this is also a passive business. So if it is a business that is passive, so you are not materially participating, you're going to pay ordinary tax with no FICA. And then on certain portfolio income, like your interest that is earned, private credit and lending, non-qualified dividends and REITs, and then stock and crypto gains held in less year, that gets taxed at ordinary income rates with no FICA tax. For the small sliver of investments that is taxed at the long-term capital gains tax, that is stock and crypto gains held longer than a year, as well as investment real estate gains when sold held longer than a year, and then also qualified dividends. To add on top of all these taxes, the NIT tax, net investment income tax, is that additional 3.8% tax for high earners on top of the passive and portfolio income. So if you're not active, generally you get better rates on your passive and portfolio income. So this is a way to still get taxed on it. Let's review this with the cash flow quadrant as well. So remember, everything on the left-hand side is active. So generally you're paying more taxes, and then the things on the right-hand side are more passive. In the employee category in the top left, this is all ordinary income, and then it's hard to offset. In the bottom left-hand corner, this is still active ordinary income, but it can be a little bit easier to offset because as a business owner, you can actually write off all of your business expenses. However, you're paying the whole 15% plus of FICA. So when you're an employee, your employer actually pays half of your FICA tax, and then you pay the other half. So they're paying 7.65% and you're paying 7.65%. In the case of when you're self-employed, you're actually paying both sides of that FICA tax. When you're a business owner, that is also ordinary income, but it's generally easier to offset because you have a lot of business expenses to do so. And then in the bottom right-hand corner, as an investor, you have ordinary and long-term capital gains income, but it's generally easier to offset and you have no FICA tax. So this is a general split between the left and right-hand side of the cash flow quadrant and how it actually works. And to plot these different letters on the same chart we just looked at, you can see that just about everything I've listed here is all investor income. So anything that's passive in portfolio, that is all investor income. And for the active income, you're either an employee or self-employed, or you're a business owner. Okay, congratulations. You now know more about taxes than 99.9% of people. You need to understand the tax strategy game and aligning your income and losses, but don't DIY it. Now let's get into the final section, net returns. Your investments should work for your portfolio and not against you. So your net return is what matters. It's your return after taxes. When you invest in stocks and crypto for a long-term hold, you're going to have long-term capital gains rates of 0 to 20%. So after taxes, this is largely efficient. You have great tax rates and no FICA tax. Next up, we have private credit or private money lending income. So this is interest that you're receiving, and it's in that portfolio income bucket. You're going to be paying ordinary tax rates on that income, so there's a pretty significant tax drag if you're a high earner. And then lastly, let's talk about real estate, and specifically the cash flow. So this is the rental income that you receive from tenants. This will also be taxed at the same ordinary rates as the private credit above, but cash flow is often offset by a lot of depreciation in real estate. So these are the passive losses that offset your passive income. So at the end of the day, the after-tax outcome is that your cash flow from real estate is largely tax efficient. You do have depreciation to recapture later in the future, so you may have to pay back some of that depreciation that you took, but in the meantime, that cash flow is largely tax efficient. Let's look at the example of a married couple in Georgia with $200K in taxable income. The pre-tax return of stocks is 10%, taxed at long-term capital gains. They're going to pay the federal long-term capital gains tax at 15%, then the Georgia state tax of 5.4%, which gets them to 20.4%. So if your pre-tax return, then you paid taxes, your after-tax return is roughly 8%. Then with private money lending, their pre-tax return is 12%, and then they'll pay up to a 22% tax rate for federal tax. Then their state tax is 5.4 for a combined 27.4% tax. So when you take that 12% and hit it with 27% taxes, you get to an after-tax return of 8.7%. And then real estate cash flow. The 8% is the pre-tax return on just the cash flow. We're not even including the real estate appreciation here. And in this case, you actually have depreciation that offsets it. So let's say you got $10,000 in cash flow, but you also got a paper loss of $50,000 in depreciation. Well, that completely offsets it, and you're not going to pay taxes on your cash flow this year, but you will have to plan for depreciation recapture later in the future. So all of this is to say that your after-tax returns or your net returns is what's most important. Your pre-tax return is not going to tell the whole story. It's truly based on your taxable income and the current sources of your income. So to wrap us up here, net return is what matters at the end of the day, and a thoughtfully designed portfolio will outperform a Franken portfolio. We want to make sure that all of our taxes are working together and not against us. Let's get into the takeaways. True or false? Passive income is always taxed better than active income. This is false. It's a bit of an oversimplification. While passive income does avoid FICA tax, which is great, it is still often taxed at ordinary income rates. However, the key difference is that passive income typically pairs with passive losses like depreciation. So while you typically pay less taxes on your passive income, this is a bit of an oversimplification. Next, net returns matter because every investment is taxed differently. This one is true. So your unique income sources and tax situation determine your after-tax net return. And that will tell you what investments make the most sense for you right now with your current income situation. Real estate and stocks and private money lending is not all taxed the same way. Next one, there's nothing I can do about my taxes. I hope we know this is false at this point. You have many options. You have pre-tax retirement contributions like your 401k and HSA. You have the short-term rental loophole. You have oil and gas deals for high-earning accredited investors. There's also real estate depreciation, tax loss harvesting, business expenses, etc. A great CPA will put more money back into your pocket by helping you harness these. And last, tax breaks are loopholes for the rich. This is false. This is a mindset. The government encourages you to do what it wants through deductions and credits. Remember, the tax code is not a punishment, it's a playbook. Don't evade taxes, avoid them. To bring us home, there are income taxes, personal taxes, and investment taxes. And seeing taxes as a game is really helpful. With the income buckets, there's active, passive, and portfolio, and all of that income is only offset by corresponding losses. And then lastly, net returns have a holistic plan for your investment portfolio so that it all works together. For our action items, I highly recommend you look at last year's tax return for your rate. And now you can probably understand the different line items and boxes a bit clearer now. So look for things like your AGI, gross income, taxable income, and what you put into your 401k, HSA, and all the taxes that you paid. Then I would love it if you took out a piece of paper and you wrote down your different sources of income and then any losses that could correspond to it. Want to put your current income into either the active, passive, or portfolio buckets, and then you could start to brainstorm what offsets that. And lastly, for net returns, one of the most important things you can do is understand your current income and your tax rate. I hope I delivered on my promise that you understand the tax game now better than 99.9% of people. This was so much of my brain power just trying to organize this in certain diagrams to make sure that the concepts stick with you. So if it doesn't work on the first time, I totally get it. Like I said, I spent 20 hours with these slides and reviewed them so many times, so I hope it is helpful for you. Coming up next in level 4, we have protecting your family. Protect the ones you love no matter what happens. I'll see you in that video.